Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options, and we finally have a little bit of an update on the S&P 500. So today I wanted to talk about how some traders might choose to test a shaky market with a bull call spread. We're going to be comparing buying stocks versus entering into a bullish spread strategy. What might be the pros and cons for that approach, and how might it be used to just make some, let's say, tentative first steps into a possible bull market rally? I think it's going to be an interesting discussion. Before we can get into any of that, though, let me first of all say hello to everybody who's already chatting in out there on YouTube. I see a lot of familiar names. Great to see everybody. But hello there, Jonathan and Charles, David, Richard, Life in the Fast Lane, Lawrence, Eva, Josh, Sharon, Ted, Jack, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But if you'd like to be here in the live stream audience, this is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that my very good friend Mike Fairborn is hanging out in the chats with us already. Mike's going to be keeping an eye on any questions that come in. If I can't get to those questions, Mike's going to be there to pick up my slack. Thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody watching, whether live or on the archive, to follow your favorite Schwab presenters on social media. It's the best place to connect with us in between the live streams when the camera's not on. You can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. And you can also find and follow me on LinkedIn. Just go to linkedin.com/in and throw on /Cameron May CS. That'll take you right to my profile. You can give me a follow. All right. But let's get into this discussion. And as we do, of course, there are risks associated with either approach that we discuss today. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And any investment decision you make in your self-directed account is solely your responsibility. All right. So here's what I want to talk about today. This is going to be our agenda. First of all, we're going to take a quick peek at the S&P 500. Look at that little bit of a rally that we've gotten so far this morning in early hours of trading. I think we were up about 1.4%, at least the last glance that I had at the S&P. And so I wanted to use that as a framework to discuss how a trader who thinks maybe there are the early signs of a rally happening and they want to take that first tentative step back into a bullish market approach might do that using something known as a bull call spread. And they may choose that over, let's say, stock positions. Now, I'm not saying that that is the best approach. Always the markets will dictate that generally after the trade is placed. But I do want to weigh the pros and the cons of each of those two approaches. And then before we're done, we're going to be actually planning and placing an example bull call spread. So if you haven't seen one before, you'll see how it's done. All right, so let's go have a look at the S&P 500. I'm on the thinkorswim paperMoney software. This is on the trading platform. In any case, here's the S&P 500. And what some may note is that starting at the peak, the all-time high that we had right at the end of January 28th, we were making lower highs and lower lows, and this has gotten us down to an interesting point at yesterday's low. From that January peak to yesterday's low, that's a retracement of almost precisely 10%. Not quite, more like 9.8%, but close enough. And so for some, they may give this a label. It's called a correction. It's a bull market correction. And for some, they might think, well, we've seen the 10% retracement. We're starting to get a little bit of bullishness. As a matter of fact, I think even over the last few minutes before I launched the webcast, we're starting to see a little bit of additional strengthening of today's rebound. And so let's say that our trader has a suspicion that over the next few weeks, maybe we're starting into a rally, but maybe it stalls out a bit. So instead of going out loading up on stock shares, they're trying to think, what else might I do to just take that first little, very cautious step into the markets. So I want to look at an alternative strategy that some might employ, known as a bull call spread. But let's go right to a stock. Just keep this in the back of our minds. Maybe, Raleigh, can you say that this is pretty light and very initial evidence at this point? Very likely, because we've been selling off now for a couple of months, and I'm hanging the entire premise of today's discussion on a move that now consists of a few hours of trading. So yeah, could be very early days. It might not work out, right? But in any case, let me bring up a stock here. I'm going to be using advanced micro devices as our example trade scenario for today. Now, how did I select this? Well, I've told you before, for some traders, they like to look for stocks that are highly liquid. That means that their options are probably going to be a little bit easier to get into and out of than less liquid stocks. Price per share can certainly play a role, especially in today's discussion. They might also look at what's going on with the chart. If we're looking for a bullish trade, maybe we want to see something that appears to be bullish on the chart. But also, I just didn't have any shares or any other option trade going on in our example portfolio on advanced micro devices. So all of those add up to, this is going to be our example scenario for the day. Question just came in from Ambrose. How can we decide a choice between a bull call spread and a bull put spread? It's a really great question. It would take me a little bit too long to really do it justice. I will say, though, bottom line is, if stock goes up, probably doesn't matter which one you choose, especially if it's the same strike prices that are used. They're almost identical strategies, almost. So what you might want to do, if you want to learn more about that, I actually have previously explored that in great detail. First of all, if you're new to the channel, welcome. Make sure that you've subscribed to the channel. So pop down, click on the subscribe button. It only takes a second to do that. It doesn't cost anything to do that. But in any case, on our YouTube channel called Trader Talks, you can find playlists of previous webcasts where you can even search through those. So I'm going to type in, if it's coming down to a decision of a credit spread versus a debit spread, and that's what Ambrose is asking, bull call spread, which is a debit spread, versus a bull put spread, which is a credit spread, both of which are bullish. How do we choose between the two? Let me type in credit and debit. There we go. And I not recently, but I have had previously a discussion of the options verticals showdown. Trade a credit or debit spread. So I think that might be helpful for you in making that decision there, Ambrose. But let's go back now to our advanced micro device and just look at it quickly from that charting perspective. Let's say that our trader has noted that, boy, over the last 6 or 7 months, there's been a pretty solid price floor on advanced micro devices after a big gap up back here in October. Ever since October, a previous high around 190 has acted as a low for prices or a support. Let's see, did we ever close below 190? Nope. Even on this day, closed at 190, almost 191. So let's just say that our trader has looked at the S&P and they think maybe stocks are going up, big maybe. And at the same time, they look at a stock like AMD and they think maybe this will go up as well. So if we're really convinced that the stock is going to go up, maybe what the trader might do is just go buy a bunch of shares. Let's say they choose to buy 100 shares. So we're going to do a side-by-side here. So we have example trade A, which is to buy the stock. So 100 shares at, let's see, what's our price? 198.25. I know this is going to change. Prices are going to change. Markets are open. So let's kind of theoretically lock this in by getting it on screen. 100 shares of 198. Let's say that's our first choice. And we're going to compare that to example trade B, which is to buy a long call spread. Let me just give myself just a tiny bit more space so this will all fit on the same line. There we go. Now, how many of you are familiar? We got 141 people watching the live stream right now. I know that most of you are probably familiar with long call spreads, but certainly not everybody's going to be. And also, there are going to be lots of people that watch this webcast after I've finished it up and we've posted it to the channel as an archive. So, but chat in, yes or no, how comfortable are you, or not how is a relative term. Are you familiar with long call spreads? Yes or no? Right? But we're just going to explore this. First of all, we're going to look at example trade A, looking at this through the lens of the pros and the cons of buying stock shares. So, first of all, we just have to acknowledge what it takes to buy the shares. To buy 100 shares of stock at $198.25 is going to be about a $19,825 investment. Now, when buying stock through Schwab, it doesn't cost anything for commissions, but there can be on other types of trades like options trades. So getting a lot of yeses, a lot of nos. Aren't familiar with this. That's interesting. Okay, so we'll make sure that we go at a pace that hopefully everybody can follow. But I think we can see right away to buy 100 shares of stock, and there's a reason why I've selected 100 shares, not 52 shares or 13 shares or 245 shares, is so that we can do sort of an apples to apples comparison here. All right, so the 100 shares is very deliberate, and you'll see why in just a moment. But if we buy those 100 shares, a stock trader knows they've just put themselves into a situation where if price rallies, they can make a lot of money. How much money can we make on our stock investment? It's actually not limited. There's an unlimited profit potential. So that's one consideration when buying a stock. Now, at the same time, we can lose, in this case, we have a maximum loss. Now, this is unlikely, but it's possible. Could Advanced Micro Devices just absolutely crater and go to zero? It could. But the maximum loss for this position is, and as a matter of fact, I'm going to rephrase this right here. Let's just take this out. Let's do this. There we go. But we could lose the full investment, $19,825, or however many shares we purchased times the price per share is that maximum loss. We also know that the timing requires precision, at least in the near term. Now, if we buy the shares and we hold on through ups and downs, most stocks, given sufficient time, will go up in price. But if the trader's immediate objective is to try to make some money in the shortest period of time, then owning shares of stock conceptually is pretty close to a 50-50 proposition, because the stock could go up from here, could go down from here. And the way that the markets have been headed, if this rally falters, we might be seeing some of these losses start to mount pretty quickly. Now, there are some other things to consider when we buy shares. First of all, we get some voting rights. I'm just going to put a Y there for yes. When we buy the Class A shares of publicly traded companies, we get voting rights. We also, if the company pays dividends, we get access to those as long as we're purchased before the ex-dividend date. Now, this isn't going to be a consideration for Advanced Micro Devices because it's not a dividend-paying company. We can look at the icons down here at the bottom. There will be a little green dollar sign to indicate that there had been historically dividends paid if dividends had been paid, and they aren't. All right. So these are some of the facts of buying shares of stock, but what might really capture the trader's attention at this point in time is this and this. Okay, there's a big investment here, about 20 grand being tied up in an uncertain market, and if the timing is off, this could really sting. So we're now going to compare this to our other trade. So it says, so according to the chats that I just got, we have lots of traders who are not terribly familiar with doing a bull put spread. So let's break it down. So with a bull put spread, what we're going to be doing is buying a call option and then selling a call option at the same time. Now, what that actually means is we're going to be entering into two contracts. The first contract is going to give us the right to buy 100 shares of stock. The second contract is going to deliver an obligation where we might have to sell the 100 shares, but at a higher price. So that's it. That's what we're going to be doing. So let's go to the trade tab, and I'm going to go to the 17th of April. On our chart, you'll actually see a red dashed line here. I've added that using my chart settings. I can actually go to the time axis, because these red dashed lines are points in time, and I can check the box that says Show Expiration Friday. What this is doing is showing us when the monthly contracts on options expire. Just gives us a visual reference point. So we see that right here. So now I'm going to go to the trade tab, and we're going to weigh maybe doing a bull call spread against owning the stock. And here's how we're going to construct that. Let's go to the 17th of April. That was that red dashed line. That's 17 days away. That's what this number in parentheses means. And you'll notice there's a number right here that says 100, because we're going to be entering into contracts that give us either the right to buy 100 shares of stock or the obligation to sell 100 shares of stock at prescribed prices. So let's go back to our chart for just a moment. And just remember, it looks like our price floor is at 190. I'm going to very carefully structure this trade so it's going to be in position for its best outcome as long as the stock just stays above 190. Notice it's already at about 198.50. That means we've come up a little bit since we started talking, kind of supporting the premise of this discussion, at least at the moment. Anyway, let's go to the trade tab. I'm going to go to the 17th of April. And what you'll see down the center of this, what we call the option chain, are different prices at which we can enter into contracts to maybe exchange shares of the stock. So here's going to be the first call option that we consider. Let me just do some quick eyeballing here. Yeah, I think what we're going to do, I like to keep the numbers when I'm teaching a new concept to a lot of to beginning traders. I like to use the roundest numbers I can. So let's use 185 and 190. I'm going to skip over the 187.5. It just keeps things a little bit cleaner. So here's going to be the first part of our spread trade. We're going to buy just one, 17th of, as a matter of fact, we'll just assume one. But we're going to buy the 17th of April 185 call. And that looks like that's going to cost us at the moment between $18.10 and $18.35 per share. Let's call it $18 and maybe 25 cents. All right. And then at the same time, and this is to complete the spread, we're going to sell the 17th of April 190 call. And that looks like that's trading between 14.55 and 14.80. Again, in the interest of just using round numbers wherever possible, let's say we do some quick math here, and I'm going to decide, let's say that we do this for 1465. This thing is still moving on me. All right, it might be more like 1470. I'm going to stick with 1465. You'll see why. Anyway, so those are our two example options contracts. So let's talk about exactly what we're getting ourselves into. At the same moment, we're spending $18.25 per share. Do the math on that with me. For 100 shares, that would be $1,825 spent. If it's helpful, I'll put it here in parentheses for us. There we go. But for $1,825, for the next 17 days, we will have the right to buy shares of stock for $185 per share. Yeah, that's at a pretty steep discount from what those shares are trading for right now. They're closer to $200. So we'll have the right to buy shares for $185. But at the same time, we've collected a premium. Someone else has paid us for the right to buy shares from us for $190. So with these two contracts, we have the right to buy shares for $185, but the obligation to sell those shares for $190. And you're probably, even if you're new to this, you're probably thinking, well, isn't wouldn't that be a good thing? If we bought shares at 185 and we sell them for 190, according to the terms of these two contracts, that'd be a $5 profit if this were a free trade. It's not a free trade because we've spent $1,825 and we've received at the same time $1,465, or if it's easier, just look at this on a per share basis. $18.25 spent, $14.65 received. What is the net cost? Now, this is setting commissions aside for just a moment, but the net cost, also known as the theoretical maximum loss of this trade, is that $18.25 minus $14.65. This is net how much we're spending to set this deal up. So let's get out our calculator. $18.25 minus the $14.65 collected is $3.60. Or in other words, net, this is costing us $360 to set this trade up. All right, so with all of that as a backdrop, here's what we can say about this trade so far. We're spending $360 for trade B to set up a bullish trade. For trade A, we'd be spending about $20,000. Can you see how this is kind of more dipping the toe in the water versus jumping into the pool? Does that make sense? Another thing we know is we have limited upside. Let me grab this right here. I'm going to copy this and I'm going to paste this down here. All right. So let's just sort of fill this out. What is the profit potential of this trade? Well, there's an equation here that we need to perform. We already know how much we've invested in this trade, and yes, that's how much can theoretically be lost. Theoretical is a key term there. There are things that can change how much we can lose. But how much can we make on this trade? Well, we know that if these contracts are, if they're ultimately fulfilled, if we ultimately decide to buy the shares for 185 and someone else decides to buy those shares from us for 190, that, let me just phrase it this way, the theoretical max gain of this trade, well, that would be a $5 profit, except it costs us $3.60 to set this trade up. So how much are we actually in position to make? $1.40 per share. It doesn't sound like a lot. That's $140. But that's $140 that might be made on $360 that's invested. That's actually quite a high potential rate of return. 140 divided by 360 is about a 39% return if this trade works out, right? But the profit potential, let me just put that right here, is going to be $140. It's not unlimited. So if we're weighing this against share ownership, if our trader here is really, really convinced that Advanced Micro Devices is ready to go skyrocketing higher, which one might be the choice for them then? Might be to buy the shares, keep that profit potential unlimited. So it's neither one of these strategies is the perfect strategy. I'm not trying to make that case at all. What I want my viewers to be able to do is to weigh the pros and the cons. If either one of these is to play a role in their portfolio, I just want them to do that in an informed way. All right. So the profit potential of this trade is $140, but that's against how much can be lost, not $20,000. The maximum loss of this trade, again, theoretically, is $360. If we invest $360, we can lose that $360, and I'll explain how this might happen and how this might happen. Now, what about timing? Actually, precision here is preferred, but not necessarily required. Our strategy with a long call spread actually has some capacity for just not being great on the timing. Even if the stock goes down. If we buy shares and the stock goes down, we're losing money. If we enter in a bull call spread structured in this way, even if the stock goes down, as long as it doesn't go down too far, it can still actually make its maximum gain. Now, are there voting rights when we're trading options? No. We have the right to potentially buy shares, but we don't own any shares. And shareholders are the ones that have the voting rights. Do we get dividends? Well, we have the right to buy shares, but we don't actually own any shares. So no, we do not qualify for dividends. So let's go explore. I've already kind of outlined how much we might make, how much we might lose, and that precision actually isn't necessarily required when trading long call spreads. Let me go back to the charts, and I want to lay out why that's the case. All right. And by the way, stock continues to strengthen. That's interesting. But let me draw in a couple of lines here. 190, you'll notice one of these options that we're trading is at the 190 strike. So just think of this as representing one of our contracts. We also have a 185. So I'm going to draw in a second line. You know what? Actually, I'll just leave it at that horizontal line tool. Let's draw in a 185. I'm going to go right down below today's candle. Let's draw that in as close to 185 as we can. That's close enough. Let me modify this. I'm going to edit its properties. And let's just make that 185. There we go. So those basically are our two strike prices, 185 and 190. So there are a few things that can happen from here. If we decide to go with trade B, the stock might go up. It might go down. And a third thing is it might go down, but wind up just between our two strike prices. Okay, Mark says, can you repeat where did you get the numbers 1850 and 1465? So these were just the current prices. These right here were just the current prices of those options at the moment we looked at the option chain. Yeah, so we were on the trade tab. We looked at the 185 and it was around, oh, look, I went over to the put side. Anyway, it was around 18 and a quarter, and you can see it's kind of still there. The 190 was around 1465, and you can see that it's kind of still there. That's it. Now, when trading options, when we buy options, we'll typically pay at or near what's known as the ask price. And when we sell options, we'll typically receive at or near what's known as the bid price. When we want to buy something from somebody, we say, how much are you asking for that? And you pay the ask price. When we want to sell something to an audience of potential buyers, we say, hey, I have this thing for sale. How much will you bid? And we sell to the highest bidder. So that might help you think of, why do we pay the ask price and why do we receive the bid price when selling? That's where those prices came from. All right, so I want to talk about these potential outcomes. Let me click and drag and zoom in on this so that we can see these. So here's where the stock is right now. What happens if the stock goes up by the 17th of April? That's our red dashed line right there. Now remember, that's the length of the contracts that we're in. Well, if the stock goes up, doesn't matter where, 200, 205, 210, 215, whatever, we have the right through April 17th to buy shares for 185. And let's put ourselves in future mode. Let's jump in the forward time machine and say it's now April 17th and our stock is worth $215. We have the right to buy those shares for 185, but time's running out. Are we going to do it or not? Oh, well, we're getting a $30 discount on the stock. Yes, we buy those shares. Awesome. We just secured the shares for 185, feeling great. But at the same time, someone else has the right to buy those shares from us for 190. The moment we buy those shares, they're sold to someone else at a $5 profit. That'd be nice, again, if this were a free trade, but it cost us $3.60 to set that deal up. So come April 17th, if these contracts are fulfilled, we wind up making $5, subtract the $3.60 to set the deal up, and that's our $140 profit. That's the fun part. Oh, Deepak says, how do you close this? Do we have to go all the way to April 17th is a great question. No, we don't. Nope. So what I'll do at the end here, let's put together a trade that takes profits as soon as we can, but also tries to cut losses if that's what's sort of starting to happen. All right. But what if the stock goes down? I kind of zoomed in too far, but yeah, I need to zoom out a little bit because you need to be able to see this. Matter of fact, I can just go like this. Let me just, don't know if you knew that you can do this on thinkorswim. You just come over to the right margin, you click and drag up and down on that, and it just resizes our chart. There we go. So let's say we don't get a rally. I'm going to take that off. And let's focus our attention down here. What if the stock goes down between now and April 17th? Ouch. Well, if we bought the shares of stock, we're losing money. Yep. On this contract, we might be losing money as well. Ooh, you know what? I kind of got a little bit out over my skis on this one. There's one thing that I wanted to talk about with a rally. What if our stock doesn't rally, but it also doesn't go down? So forgive me. I'm going to hit the pause button on what I was just about to talk about. And let's just say we get this. The stock goes down, but we're still above 190 at expiration. Let's say we're at 191, just to make a nice little round even number. Well, if we bought the shares at $198 and then we go down to 191, we're down $7. It's not good. But actually with our vertical spread here, our long call spread, we're actually still in max profit territory. If the stock's at 191, we hit expiration, we have the right to buy shares for 185. Are we going to do it? Yeah, we're still getting a $6 discount on those shares. So we buy the shares at 185. Someone else still buys the shares for 190 because they're getting a discount still. So we buy the shares at 185, sell the shares at 190. It's exactly the same outcome. So that would be our maximum gain scenario. Make $5, subtract the cost to set this deal up. And even though the stock didn't even go up, we were wrong on the precision of our timing. But a bull call spread, to some extent, has the capacity to absorb some timing issues. Whereas if we just bought the stock, we'd have an unrealized loss of $7.25 at that point. All right. So that's an important point. But let's talk about this. Let me remove this drawing. What if this happens? What if our stock just goes plummeting down? Let's say we're down here at $180 on April 17th. We have the right to buy shares for 185. They ain't worth 185. Nope, not going to buy them. Someone else has the right to buy those shares for 190. They're not worth 190. You know, they could still buy the shares if they wanted to. If they wanted to overpay us by $10, they're probably not going to. This almost certainly in this case, we just lose our investment of $18.25. We keep the $14.65 as a consolation prize, but net, we just lost the $360 that was spent on this trade. Ouch. We just lost $360. That's not fun. But what if we had purchased the shares? If we bought the shares at 198 and they're worth 180, we're down $18 and change. That's $1,800 on 100 shares. So you can see how once again, we're just sort of dipping our toes in the water. We're risking 360, but theoretically, that's the most we can lose. I keep saying theoretically. I'm being very deliberate about that. And you're probably wondering, why does he keep saying theoretically? Because it can also work out differently. But in this case, we lose the 360 rather than making the 140. So this trade still has a bullish bias. Would we prefer that the stock just go higher so we can be less nervous about it coming down? Yes. Could it still come down as long as it stays above 190 and we still are fine? Yep, it's going to be a little bit more touch and go, but our preference is for the stock to go up from here. Now, there is a third, I guess it's now our fourth potential scenario. What if the stock falls? It gets below 190, but it's still above 185 at expiration. This is important, especially for those that are new. We need to know what happens if we let this play out? Well, if our stocks, let's say it's at 187, all right? If the stock's at 187 come April 17th, we have the right to buy the shares for 185. We're getting a $2 discount, so we buy the shares. And we're like, okay, we got the shares at 185, waiting for someone else to buy them from us for 190. They're not going to do it. No, because if the stock's only worth 187, even though someone has the right to buy the shares from us for 190, they're almost certainly not going to do it because it's just not worth that much to them. So they just pass. All right. Well, let's do the math on that. How did the trade go overall? Well, we actually wound up buying some shares at a $2 discount. So we got some value there. We got $187 stock for $185, a $2 discount. But we spent $3.60 to set this deal up. We're actually a little bit underwater on the trade overall. Plus, maybe we didn't want the shares in the first place. So if we wait till expiration, and if the stock is between the two prices, between our two strikes, we may wind up owning shares we didn't intend. And maybe you think, well, maybe I just won't exercise my right to buy the shares then. If we allow this to get to April 17th, we actually, that decision is taken out of our hands. If the stock is below our strike price at expiration, that contract is exercised. All in the money contracts are exercised at expiration automatically, unless there are explicit directions left beforehand through what's called a do not exercise order with the broker. That's fairly uncommon. So there we go. Those are some possible outcomes here. And I think you can see why, for some traders, they might use this as a way to just sort of dip their toe in the water. Rather than making a big commitment to a bunch of shares, they might enter into what's called a bull call spread. Now, before I go place a trade, a couple of final points here. Why do we call it a bull call spread? Well, it's bullish spread. Obviously, we prefer for the stock to go up than down. It was constructed using calls. And the term spread just refers to the fact that we're using two different contracts where there's a spread between the prices, 185 and 190. There's a distinction between those two prices. For some, they actually refer to that as a vertical spread because 190 is higher than 185 in price. Okay, so the other final point that I wanted to make before we place our trade is that for some, they might think, oh, maybe instead of dipping just my pinky toe in the water, maybe what I'll do is put all 5 toes in the water and I'll do 5 contracts. Or all 10 toes. Let's do 10 contracts. It's such an inexpensive trade. Well, if we start doing more contracts, that dials up the risk rapidly. Let's say instead of doing just one contract, spending $360, we do 10. That's $3,600 that can be invested and also lost. And you'll notice it didn't actually take much of a drop in price to lose that much money. So adding more contracts can actually swing the dial from this being a more conservative position to a more aggressive position. It can do it very easily. All right, so let's go place our trade. And Deepak had asked the question, how do we close this out? Let me show how to do that. I'm going to go place our trade. So there's a quick process for placing a vertical spread on thinkorswim. What we do is we just hold down the control key on our keyboard. And you'll notice, you can see when my finger is on the control key because I start to get hotkeys that pop up here, 1, 2, 3, 4, 5, 6, 7, 8. But when I'm holding down the control key, I can click on the ask price of the call that I intended to buy, and that creates a buy order. And let me just minimize that. And if I hold down the control key and click on the bid price for the call that I intended to sell, that was the 190, it adds that to my buy order. So do you see that? This is now constructed a vertical spread. Looks like it might cost us a little bit more to buy this because price is moving in the right direction. This contract is getting a little bit more expensive to set up. Anyway, I'm gonna dial this down. Let's just do one contract, the $360 that we discussed. although it might have to be more than that. It looks like we might have to pay $380, maybe even up to $410. You know what? Nice round numbers. I like the nice round numbers when instructing. Let's say it costs us $4 to set up this $5 potential outcome. So that would leave $1 of potential reward on the $4 invested. I'm just going to put that in at $4. I'm okay with that. Now, what we're hoping for here is that our $4 becomes worth $5. So we want the price to go up. It's possible the price might go right on down. So here's what I'm going to do. I'm going to put in a couple of closing orders. So instead of just putting in a single order, I'm going to put in what's called a first triggers OCO. Just know this order type is saying our first order, if it fills, will trigger 2 exit orders. And one of those will cancel the other. Order cancels order, or one cancels other, however you want to phrase this. That's the OCO designation. But it allows us to come up here and I can right click on the original order and create an opposite one. Let's use this one to take profits. I'm going to right click on it again and create a second opposite order. And this one is to take our losses. All right. So first of all, let's talk about the fun part. Let's say that our $4 is making its way toward 5. And let's say we'd even be happy if we're able to get out for 80 cents more. That would be a 20% increase in value on our contracts. I'm going to make that a good till canceled limit order. That means I want to sell for that price, not a penny less. That's my limit. The other one, we're going to sell and close it out if it's going the wrong direction. Let's say we want to give this a chance to work, but if we're starting to move towards 0 value in our $4 investment, let's try to stop the bleeding there. I'm going to make this a stop order for $2. So what that means is if our $4 investment has fallen in half, I'm going to stop the bleeding. Or at least we're going to have an order in there. A stop order is not a guarantee that we will close out for precisely that price, but it is a trigger order. So if the stock falls down to that value, it fires off in order to get out. It might actually be that we sell for less than $2 if stock price is falling rapidly. But anyway, this means that we don't necessarily have to wait until April 17th to either take profits if they happen or cut losses if that's what's happening. So let's click confirm and send. We're going to buy this one vertical spread, the 185, 190, 17th of April call spread. Try to do that for not more than $4. And then we're going to try to close it out for $4.80 for a profit. Or if it's falling the other direction, $2 loss. Now, to get into and out of options, there is a 65 cent per contract commission. Not 65 cents per share. It's 65 cents per contract. So that does dial up the cost of this trade from $400 to $401.30 to pay for the call that we're buying and the call that we're selling. Okay. And let's send that order off and we'll see. Yep. Okay. Oh, look at that. That's pretty funny. I offered $4 and it actually only cost us $3.65 to get into that trade. So pretty darn close to what we were talking about all along. So there we go, guys. We've talked all the way through how for some traders, they may choose to take that first. We've reviewed the markets, use that as a backdrop for structuring this discussion of buying a stock versus a long call vertical spread. And we've actually planned in place an example trade for the day. I hope that this is helpful for you. This is what we do with our Tuesday webcasts. So if this is your first time, I hope that you'll put it in your calendar to join me each week or to just watch the archives. You can do it that way as well. So as I let you go, just remember, if you're new to the channel, pop down, click on the subscribe button. It only takes a second. It doesn't cost anything to do that. But our YouTube channel is where you can find and join the live streams. You can also find the playlists for previous discussions. Now, the other suggestion that I would have for you is to follow your favorite Schwab presenters on social media. You can find Mike and me on X. You can find Mike on X at Mike Fairborn CS. You can find and follow me on X at Cameron May CS. There's my handle. There's what I look like on that platform. I'm very active on this platform. And if you reply to me on X, I just try to reply right back to you as well. You can also find and follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. That'll take you to my profile and you can give me a follow there. But guys, thanks for giving me your time today. I will look for you in next Tuesday's webcast. I also have something every day of the week. As long as the markets are open, as long as I'm not on vacation, I'm delivering a discussion of some topic every day of the week. So look for me in the rest of the week in the calendar. Mike, thanks for helping out. Thanks for all the thumbs up, everybody. That's always appreciated. If you enjoy one of our webcasts, make sure you click the like button. It's a nice pat on the back to your presenter, and it also gives my webcast a nice boost in the YouTube algorithm. All right. I'll see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.